All right, everybody. Hey, welcome to our Note Nation Top 40 Tour as we roll into the city of brotherly love, Philadelphia, PA, everybody. So welcome to this webinar. Welcome to us breaking down 40 cities over 49 days. It is definitely a amazing time, not only diving into the information, finding out the trends of what's going on in each market, but also the people that we're connected with, people we're meeting across the way. So if you're a fan of Philadelphia, or from the surrounding area, and Philadelphia is one of your investment markets, hey, I think you're going to get quite a bit out of tonight's or today's or this afternoon, whenever and wherever you're watching this from. Hey, welcome to the Note Nation Tour. We're honored to have you, and we've got a lot of stuff. I know we have local and national investors paying attention, existing real estate investors also looking at, hey, what's going on, what are the future trends, where the opportunity is going to be. We also have new people looking to get into this information or getting into real estate. We'll talk about statistics and numbers. We'll talk about the second half outlook of 2020. We'll talk about future opportunities, and then we'll also share with you how, where, and when to get started to make the most of your investment time. Well, if you don't know who I am, everybody, I'm Scott Carson. I've been an active real estate investor for almost 20 years now. Got started back in 2002, but I've got a distressed debt, finance, mortgage background since 2004 when I got in. Really, as a full-time, I should say, as a profitable real estate investor. Over the last 10 plus years, I've purchased over $500 million in debt. I'm the CEO of WeCloseNotes.com. I have a passion for teaching real estate investors, and I've been doing so since 2010 while also being an active investor. So I have a little podcast called the Note Closers Show that's listened to millions of investors all across the country on a monthly basis. I invest in roughly about 30 markets. And yes, I currently invest in the Philadelphia market. I currently buy in stuff in Pennsylvania. And I've been doing that for a few years. But Austin, Texas is my home. That's where I hang my hat. And that's where I'm going. Or that's where I'm from, basically, and joining you on this evening. But anyway, why am I doing this? Why am I showing up on a Sunday night, a Tuesday night, a Wednesday, a Thursday night? And why am I taking time on my schedule to identify opportunities in all these 40 markets and share those numbers with you? Is because of a couple of things, a couple very important things. And I encourage you to ask questions, because I do love to help investors. I have been helping, like I said, I had a passion for helping real estate investors for over a decade now. I was very fortunate, I had some very good friends, very good mentors help me out when I got started. And I always promised, since I was in such a unique position, that if I could help anybody along the way, I would. I love to help people solve problems. It's actually one of my five love languages is being a problem solver. How do I help people identify opportunities? How do I find people to fund stuff? How do I find deals for investors out there that are limited on budgets? I'm a big passion of that. And I'm also doing this because I believe this is the opportunity. Not trying to go out and wholesale stuff, not trying to go out everywhere, not trying to do the old-fashioned way of things. Look, investing is involved and the markets are evolving and changing, and you've got to evolve to stay up to date with what's going on. Real estate investing is its own, I guess you could say, storm. We're about to see another storm that we're kind of passing through the eye of. It's going to get worse before it gets better. And I also do this because I was once a distressed borrower. Going back to 2002, I was a deadbeat borrower. I was facing foreclosure. I was in default. And I've always empathized with people that are in struggle, that are going through financial difficulties of any given time, whether it's their own fault or it's not. And we all know there's been a lot of times, especially you look back 10 years ago, a lot of people were in financial dire straits, not to anything that they did. Well, we've seen that happen right now. There's a lot of people out there. And then if you can help them, which I love to do, then you're doing God's work, I think. And I think there's nothing greater than helping someone overcome an obstacle or achieve a goal or dream that they thought was impossible. And I know many people, when they're down their lucks, they're like, I can't. It just seems that the world is against them. And I've talked to so many people, investors, borrowers, and people up there like, I don't think I can do this. And I love helping people overcome their obstacles and achieve goals and dreams. And one of the best things that we've ever done is being able to help people overcome things. So I encourage you to hang around. We'll be in and out of this thing less than an hour, and you can be back on your merry way. So what do the national numbers say? Yes, we know it's kind of a rough time out there. 11.1 unemployment rate as of June 2020. That's scary. Basically, 1 out of 9 borrowers or 1 out of 9 people are unemployed. That means there's 17 0.8 million people unemployed out there right now. That's crazy. 52% of small businesses are expected to fail here in the next 6 months, if not sooner. 10% of homeowners were already struggling to stay current before the market. That's homeowners trying to stay current on their mortgages. There's also a lot of people who are in default on a variety of other debt, their car payments, their medical bills, all sorts of things out there. Currently, the national mortgage default delinquency rate right now is 7.76%. So the thing you got to keep in mind, if you think back to 10 years ago, 12 years ago, the statistics always said, oh, we never expect the default rate to be above 8%. And then that's when everything started happening. More foreclosures, more defaults, more everything. What we saw a couple years, 12 years ago. Well, we're almost at that point again. Now, there are currently 4.1 million Americans currently in default. All right. And it's going to get worse. Yeah, they talk about, oh, yeah, there's some more people making payments. No, it's going to get worse as things, and we see this taking place already out there with more people getting sick and more people being laid off. And if you compare the numbers, in comparison, it took 18 months back in 2008 for us, when everything started in 2008, first at 1.6 million defaults in 2008. We're way beyond that. We're 2.5 times that. We're not even a year into this whole situation, everybody. So keep that in mind. We're going to see some, I hate to say it, but a lot of things, a lot of people are going to need some help. And you can either be somebody that helps out and it really does creates win-win-win scenarios, or you can be part of the problem. I like to be part of the solution if possible. And that's one of the things we'll talk about tonight. How do you leverage what we're going through, not only to help you guys out, but also help the other people on the other side of the thing. We all know the loan delinquency rate record high spike in 2 months. This is back in a couple days ago. You see on here in June, non-prime, it's the subprime side of things. Yes, we have subprime. People say, oh, subprime's not around this time. Well, yes, it is. We saw a 21% increase in delinquencies last month. Prime loans saw an increase of 12%, second highest increase. Reperforming loans had another 6% increase, okay? And then prime loan delinquencies increased another 5%. That should tell you something. It's increasing, all right? Now, if you look in Philadelphia, I pulled this number up here. I thought you guys, this is the unemployment rates for just Philadelphia area by county. And you see the United States is at 4.5%. And you can see how it's different. Chester County is below that. Some of those are below that are right around Philadelphia County, but Philadelphia County, PA is at 7.1%. That's almost 40% higher, 30% higher than the national average. And so that's the thing to keep in mind. If you guys are investing in Philadelphia, look at investing or living in Philadelphia, you're going to be affected by this, okay? And so you need to know what you can or can't do. So let's talk about some of the foreclosure markets. For some reason, it would pull up an actual map of this with the Realty Track, but you can see that on average, there's 1 in every 12,000 borrowers are in default across the board. And these are the top 5 zip codes. 19127 is just under every 2,900, which is actually not bad compared to some other parts of the country. I'll give you an example. Compared to Chicago, you're 3 times better than Chicago in a positive state, not in a negative status. 19125 is 1 in every 5,400. Down in 19139 is 1 in every 10,000 homes. So that's great for those areas, but we know there's a lot more than just these zip codes. Okay, number of foreclosures out there. This is you can see prior month 0% increase. Prior month basically the same. Obviously, things have come to a halt on the foreclosure side. If you're a real estate investor looking to buy foreclosures or REOs, those are bank-owned homes. We know that there's still some out there, but you can see that the numbers have dropped off dramatically in July compared to May. And that the numbers, obviously, pre-foreclosures have dropped off because things have been suspended until we figure this thing out. Obviously, the can, if you can't hear it, the can is getting kicked down the road for a few months with forbearance agreements and things like that. And you can see that the number of new foreclosure filings obviously has dropped just because of everything got suspended for a while, which is great. That's great for people that are in trouble. They're in trouble, they're struggling, it's been delayed. But the second shoe is going to drop at some point. So let's talk about, is this good news or bad news for us as real estate investors? 1 out of 15 borrowers are in default. Actually, that number is a little bit, that's about right. 1 in 15 borrowers roughly about default. Pennsylvania is actually higher across the state. All right. Is the 13th highest state in the country in default. Okay. 13th highest. And Philadelphia, obviously being one of the largest populations, is part of that. And the thing that's struggling for those investors that are looking for foreclosures or REOs, are looking to jump into that. You've got a longer FHA and Fannie Mae foreclosure time frame in Pennsylvania. Roughly, it's a judicial foreclosure, 690 days to foreclose with Fannie and Freddie stuff. Now, obviously, we know it's a little bit faster than that if you're not a Fannie or Freddie foreclosure, but still, you're looking at roughly a year still at least for foreclosure once you start everything. And we all know this backlog of forbearance agreements is going to drag things out further and further and further. Now, the forbearance agreements are great, but if people default because of being laid off or sick or anything to go to the coronavirus, the banks and the judges and the counties are going to be hesitant to foreclose. And they put in a 12-month cancellation of foreclosures or evictions. It's going to affect investors and bankers in a negative way. It just is. You can't keep kicking the can down the road. And it's going to be a while before REOs hit the market. And I'm going to say 12 to 18 months before foreclosures and REOs actually hit the MLS, hit the market for most investors. But you're at the bottom of the line. You're at the end of the line, which has gone through foreclosures. There's a lot of opportunities to be had between now and then. Now, let's say the foreclosures of the pandemic. Oh, here we go. I'll give you some numbers on this. You can see this is across the different loan types that are available out there. Conventional loans have the lowest at roughly 3%, because most of the time conventional loans are requiring somebody to bring some money down. They've also got pretty good credit. They've got to usually probably have some reserves. And they start getting into the VA loans a little bit higher, and then they have the all loans on average across the board are about 4.3%. But the FHA loans, we're going to see a huge amount of FHA foreclosures because the default rates on that's almost 10%. Now, why is that? Why is that? Because those are often first-time home buyers that, in a lot of cases, the banks in the last year have been either donating the down payment or donating up to 10 grand towards closing costs, or basically borrowers are getting into homes for the first time with no skin in the game. Not that it's a bad thing, but we also know if you look back at the numbers from 2009 there, the FHA rate was at 14.42% default rate, which is pretty close on that time frame where you start seeing numbers increase and climbing back up. We're going to see as bad as 2008? I don't know. I think we will in a variety of fashions. Okay. Now, we all know forbearance agreements continue to retreat as they talk about this. People, 56,000 less across the country who have stopped their forbearance agreements. Yes, that's a good thing. But as states shut back down again and things get canceled and we keep delaying jobs in the job market, we're going to see this kind of, these numbers start to increase. I expect, especially July, when the numbers come out for July and August, we're going to see an increase in forbearance agreements, increase in defaults. Here you go. Here's roughly, you can see roughly about 5 million Americans across the country are in active forbearance agreement. You see FHA is the second highest. Fannie, Freddie is the third highest. Others are on the lowest. The others are probably going to be more your conventional loans, obviously, because they required the borrower to be a little bit more seasoned, to be a little bit more prepared. Okay, but this also leads, what's not showing if you're real estate investors are the owner finance mortgages or the non-conventional mortgages that are in default across the board. So we've talked about residential debt. Philadelphia has a pretty strong real estate market. I'm not going to lie about that right now. Matt Talent with the Compass Group was talking, and I was talking with him. We did a podcast episode about the Philadelphia investor market, and him and Jesse Johnston over at the Compass Group talked about, hey, there's a lot of stuff moving. There's, roughly 2-3 months of inventory right now. Things are moving in a positive fashion on conventional real estate. Rents are high. Average market rent is going to be at least $1,000 or higher for the most part. If you get in a rougher area, it's going to be well below that. You want to avoid that. Okay. So it's a good, strong market. It's done well to recover since the last time, but the numbers don't lie when it comes to the things that are unaffected or that are affected by everything going on with Corona. We all know that commercial rents are being fought over. Are the tenants going to pay it to the landlords? Okay. We talked about businesses failing. As businesses failing, office space, commercial space starts to take a hit as well. Okay. We all know the real estate, commercial real estate has been in a long boom, and it is ending. Not could it, but it is ending as storefronts, offices, whole variety of things are changing across the board. Now, if you look at the commercial mortgage market, 1 in 5 hotel loans are in default. Yes, 1 in 5, 20% of hotel loans are in default across the country. 1 in 10 retail loans are in default. Okay. Office vacancy is set to increase to almost 20% nationwide by the year end. It's also, we're expecting a 15% vacancy rate for retail and restaurant space all across the country. Philadelphia is not immune to that. It is also seeing that. We're expecting to see rents on commercial space fall at least by 10% by year end, and then also another 4 to 5%, if not more, in 2021, depending on the asset class. Now, that's a scary thing. You know, delinquency rates are tripling across the country. We all know commercial mortgage-backed securities, but this article came out June 1st. We're seeing the commercial meltdown. We all know that in March, there's over $50 billion in commercial mortgage-backed securities that basically went to a $0 value as everything stopped. And as the delinquency rate triples, the value of that real estate goes down. It also leads to some tough decisions that landlords, owners of the properties have to make with the tenants. It also makes sense for the banks have to start figuring out things to do with the borrowers on this and going back and forth. Yes, there's a lot of forbearance agreements. There's also people that just aren't paying. They're hoping that, hey, we'll just add this to the lease, we'll add this to the back end. And at some point, somebody's got to step up and take accountability. Hey, somebody's got to pay. People have got to make money. Here's a great article that I read just today. It came out a month ago. But talked about that, hey, there are a lot of opportunities in the commercial base beyond the CMBS aspect of things, the commercial mortgage-backed securities. And if you looked at the numbers in 2007, it was different this year around, okay? In 2007 and 8, 64% were originated out of the market. Now, in 2019, same market accounted for just 21%, while banks issued 53% of the distressed loans. That's the thing. More banks have gotten into the trough of financing this commercial real estate stuff. And it's just the tip of the iceberg, as they like to say. There's literally so many banks, and you look at what much the loan to values, they're all at 70% or higher, roughly around 70%. Okay. Banks of all scales have captured a larger share of the commercial mortgage activity than the CMBS market. So what does that mean? Is that you have banks that are going to have stuff on their books they're looking to get rid of. It's not just going to be the big guys out there. There was an article, maybe I've got it down here, maybe I don't. Talking about that most banks aren't looking, most of the investors, the big guys, aren't looking for anything under $2.5 million in balance or in value. That leads to a lot of opportunity for investors like you and I. All right, well, if you come back here to this last one. If you can see down here at the bottom, the banks don't have the incentive to clear stuff out. They're also chock full of capital right now, and regulators are telling them, don't worry about capital reserves at the moment. At the moment, they are already seeing banks. I'm already getting phone calls from banks about looking to move this stuff off their books. If you can step in and start providing capital to buy out some bad loans or work with current borrowers to try to reposition the property, he goes, that's one of the best things on the aspect of this. Now, if you look at what some of the bigger investors are doing now, the billion investor, Carl Icahn, has been shorting the commercial market for a little while. This was back in March. He says, basically, it's going to be like 2008 all over again. You're going to have this blow up and nobody's even looking at it. He talks about the commercial markets. Well, we are. All right. He's obviously buying a lot of credit default swaps, which, oh my God, that's the Big Short all over again. It's happening all over again due to loans made in 2012 to shopping malls and a whole lot more. You have a bunch of mortgages, so the banks went out and loaned money against a lot of shopping malls, all office buildings, hotels, and retail. It's all credible institutions doing it again. Okay. They slice and dice these up, and so a lot of these bonds are now in grave danger. It's like selling insurance to someone who's going to go to the electric chair in a couple of months. Sad, sad thing. So where are the opportunities at? Where do the opportunities lie? Now that we've scared, like, oh my gosh, when anything's getting distressed, when there's blood in the water, which there's a lot of blood in the water, there's a lot of opportunities for you. Now, are you going to look for foreclosures or REOs? REOs stand for real estate owned? Not for a while. That's 12 to 18 months. Fix and flips, yeah, you're not going to see many fix and flips. Every realtor I talk to in the market says, for the most part, they're not seeing big discounts you know, from borrowers. Yes, you can finance up, yes, but the cost to market, because we're in this gap between what people think their property is worth and really what it is right now. Banks, sellers think their property is worth this. Investors are coming in and up, but still there's that big divide. Yeah, it's getting tighter and narrower of a divide, but we see this all across the country. Are you going to see a lot of rentals? You're going to see a lot of people who have taken their short-term rentals and try to convert to long-term rentals, but you're also seeing a lot of rentals that are going to hit the market in a distressed space where there's nobody there to rent them, especially if the colleges don't show up, if the games don't go on like you're talking about potentially doing. There's going to be a lot of rentals that the market's going to drop down. Rent rates are going to drop, okay? So where do the real opportunities lie? Well, that lies in the debt game. What I mean by that? Well, that means by buying residential notes, buying from the banks, buying from institutions. We're going to start seeing residential notes in the fourth quarter here in a few months. We're already starting to see commercial notes this quarter, right now, coming out from banks. Banks, yes, they may not have to have as much as reserves, but when I start looking at the banks out there, you're starting to see some banks really start to see things increase, specifically in your guys' market there in Pennsylvania, okay? Now, there's also people getting creative. When you have a big apartment or hotels, there's a lot of hotels out there that are at 30% 30% occupied or less. That doesn't mean for a very good investment in the hotel space. You're going to see a lot of hotels that are going through conversions, just like this institution did in Chicago. They took this this hotel and converted apartment complex. Our buddy Garrison Gilbert is doing this in Gettysburg, Pennsylvania, actually, taking a 55-room hotel and converting it into 42-bedroom apartments. Convert it. It's already a residential spot. What's it take to convert it and add a few things to it? You've already got the rooms. Why not? All right. Now, the banks in trouble. Are there banks in trouble out there? Whereas we had 300, 400 plus banks that went out of business 12 years ago. Are we seeing that right now? Not yet, but there are things in trouble. Now, one of the things that we pull on a regular basis is there's a thing called Bauer Financial, and they are a ranking system that ranks banks and credit unions across the country by their reserves and what they've got in default. And we just recently got the list for June, about a week and a half ago, 2 weeks ago, and it's kind of disturbing looking at the numbers. Now, it can be overwhelming because I always like to ask for just banks that have 5 branches or more. They're the ones that are usually they are usually get a little bit more aggressive in their lending tactics because they've got multiple branches and a bigger overhead. So you start looking at this, there are thousands of banks with offices in Philadelphia, in Pennsylvania, across the state, but there are 87 major ones where their main office is in Pennsylvania. That's a pretty good chunk, and a lot of them are there in and around Philadelphia. Now, if you look at those out of the 87, there's over $1 billion. That's not all the banks. We know that there are hundreds and thousands of banks lending in Pennsylvania and Philadelphia. But out of the 87, there's $1 billion in loans that are 90 days plus in default. Billion, all right? By looking at the numbers. I know exactly who those banks are. I can look at them. I can see their ranking. I can see a percentage of their portfolio. That's actually at least 5% on average. Some of them have higher, some have a little bit lower, but 5% average of each bank's loans are 90 plus days past due. Okay. Now, how that breaks down, out of that billion, a quarter of it is in the single family residential market, which that's a lot. It's a lot of loans that are in default, and it's going to get worse. And the two biggest heavy hitters, one is First National Bank of Penn, with 139 million in 90 plus defaults over the 379 branches. And the second largest bank that's based there is Fulton Bank. They've got 140 million, a little bit more in defaults, and they have just 239 branches. Think about that, 239 branches across their lending platforms, 379 branches. That's a lot of borrowers they've lent money to. And that's just on the residential side. The commercial side's obviously $750 million on the stuff that's in default. What does that mean? That means lots of opportunities to create win-wins, coming in, helping the bank out by buying the stuff at a discount, but also stepping in and working to make Make America great again, as I like to say. So why should you buy distressed debt? Why should you look at that? Why would you do that versus anything else? This is because you can start buying debt now versus waiting around for foreclosures, which may take 6, 12, 24 months for it to hit the market. You purchase the debt at a significant discount, big discounts compared to the location, the foreclosure timeframes, values, conditions, etc. You can purchase the debt and then either A, control the asset in a variety of ways for huge discounts. And you're usually buying debt somewhere between 30 and 70% of either the value or the unpaid balance, whichever's less. On the commercial loan stuff, if they're at 70% LTV, I'm basically not going to, I'll probably pay 50 cents of value. So I might no greater than 50% LTV. All right. Because if I've got to step in and I've got to hold that asset for 6 to 12 months before I could start the foreclosure process, hey, but that gives me a lot of flexibility too. If I'm into it for half than what the bank is, that gives me a lot of flexibility to work with the borrowers to put something together, either forbearance agreements or payment plans. Try to get them to reinstate the loan. Hey, I know you're 6 months behind. Let's just add that to your lease, or let's just add that to your loan. Modify it. Or let's do a short sale or a short payoff or foreclosures, loan sales, deed and liens, cash for keys. There's a whole variety of things you can do, not only on the commercial side, but the residential side. And the thing is too, if a borrower on a commercial property stops paying, you have the right to take over receivership to start collecting rents. That's a big, big thing when it comes to commercial debt. You take that middle party out of it and go direct to the borrowers to work with it. Direct to the tenants. Take over the note, turn it into a cash flow, performing note while it's getting worked out. We've done this before in a variety of fashions on commercial properties when we bought the notes and took the property and took over receivership and started taking control of the property. Okay? You do whatever you want to it once you take the property. Keep the tenants in place there. If it's a residential property, great. Foreclose or evict if you need to. I don't think you want to evict. I think you want to keep the people in place. And I think there's a lot of incentives for coming out smelling like roses because of the fact that you bought the stuff at a big discount. It gives you such an opportunity to allow people to get back on their feet, to allow them to get through this nightmare and really do some good. Other advantages of note investing. Hey, if you're a new real estate investor, you're not going to be spending a lot of money in direct mail costs. We don't do any direct mail. We're not mailing out thousands of postcards, letters to borrowers, or to the foreclosure list because those things are shut down. We don't do that. We don't waste our time. We go direct to the banks, okay? If you've got emails, LinkedIn, and you can dial for dollars, pick up the cell phone and make some phone calls and know what to say with scripts, guess what? You can do this business. I don't care who you are, what your age is, what your experience is or background is. I don't care what nightmares you've gone through. I don't care if you've got $1 million in the bank or $0 in the bank. You can do this business. One source leads to regular deal flow. That's the beautiful thing. If I'm talking with those banks, I'm getting regular quarterly lists from them. I'm not getting, I'm going to mail out 1,000 postcards to get 4 people to call me, and then maybe one deal comes from that. No, I'm going to get lists and lists and lists that I can reach out to on a regular basis so I can cherry pick the best deals for my own portfolio. I don't have to do a skinny deal. I don't have to compete with everybody else chasing the lowest, the bottom of the barrel stuff. I want good stuff. I want stuff that nobody else really has access to. Nobody else is looking at 6 to 12 months. If I want to buy in bulk, put some money together, great. You can get better deals as well. You can do residential commercial assets because most of these banks are going to obviously have a variety of stuff on their books they need to get rid of. Nobody's reaching out to them for the most part. Okay? And the beautiful thing is like, well, if Scott, I don't have any of my own money. You know what? There's plenty of investors out there to help you fund your deals. Okay? There were 15 million homeowners underwater at the peak in 2010. 15 million homeowners. We're going to exceed that when the market drops. And so let's talk about, are there investors out there? Well, hell yeah, there is. There's $9 trillion in retirement funds out there right now. $9 trillion on the sideline. Maybe it's taking a little dip, 8.5, whatever. But there's $9 trillion in retirement funds out there. In Philadelphia alone, we pulled some numbers, and there's 89,000 investors who have an IRA in Philadelphia, whether it's a self-directed IRA or an IRA with a bank or investment company. 89,000 investors that have an IRA, an individual retirement account. Okay, out of those 89,000, 59,000 of them have at least 150 grand or more in their accounts. Basically, 66% of those have at least 150 grand or more, and you can do a lot with 150 grand. How many of those do you need to raise $1 million? 6, 7? That's not a lot of people to raise $1 million to go buy some stuff, everybody. And in Philadelphia too, 58,000. There are 58,000 pure real estate investors, not agents, not brokers, real estate investors in the Philadelphia area. It means there's a lot of people looking for deals. If you can be a deal engineer, they're finding the deals and either wholesaling it for a flat fee, taking it down, getting investors to use their funds to fund your deal and partner on the deal. A lot of opportunity out there, everybody. Do you want to be the banker or do you want to be the borrower? Well, I always say you want to be the borrower. Not the borrower, sorry. You want to be the banker, everybody, okay? You want to be the banker because the bank always wins. The bank always wins. We always win in a unique way because we are able to take things and do things as note investors that your traditional foreclosure guys can't. They're waiting for everything to be done. That's why they're paying through the most. When things go to foreclosure and scenario, the bank is going to sell it through the nose as best they can. You're going to get your real deals these days by buying the debt in a variety of fashions. So how do you tap into the tsunami? A lot of great ways to do it. I've been teaching and had a passion for teaching investors about notes since 2010. I've helped thousands of investors purchase their very first non-performing note, whether it was one-off or and it led to 2, or it led to 20, or it led to 100 or 100 plus. You know, whether it's residential, commercial, now is a really great time to be done it. Commercial real estate, I think, has been overpriced for a while, but we obviously know it's on sale. Residential has been peaking, cannot keep going up. And now it's on sale again here before. And you can do a variety of things. Most people are buying it for cash flow because they want to build long-term wealth, or they're building it for asset growth. I want to buy notes and add property and I take it back, or I want to add value to my portfolio. You can buy one-offs. Yes, banks will sell you one-offs, or you can buy in bulk. Now, you're not going to buy from Bank, America, Chase, Citi, Wells Fargo. You're not going to buy one-offs from those guys. You're not going to even buy bulk unless you've got 50 million. But there are still roughly 1,800 lending institutions out there, and if not more. You add, that's bank institutions. That's not even private money lenders, hard money lenders, non-bank lending institutions out there that have been originating mortgages over the last few years. There is so much distressed debt out there right now that we need investors like you and me. The market needs us to step in and help out in any way we can. Whether you've got 25 grand, is what we see is like an average. Hey, that allows you to get back like one asset here and there somewhere, or you've got a couple million. I mean, we've funded some bigger trades and done well. From one-off for $7 all the way up to 175 assets for several million. You don't need credit. The bank's not going to check your credit report. You don't need your own funds. We already talked about the fact there are so many investors in Philadelphia or across the country. If you've been on any of these Note Nation tours, you know that that number changes every time we do this because we research the markets. And if you're looking, oh my gosh, Scott, I need a list of investors. Hey, we can help you out with that as well too. But you can start getting deals if you're using your email, LinkedIn, and phone and get started there. So whatever your focus is, whether it's single family homes, apartments, hotels, retail, self-storage, mobile home parks, deals come in all asset classes for all of you. And you can create win-win scenarios and stories for you guys. I've helped so many borrowers across the country stay in their houses. This one lady here was trying to do a loan modification for 4 years. She lived in her house for 20 years and she was facing foreclosure. We stepped in, bought the note, was able to, we bought such a discount, we were able to negotiate a loan mod with her on the phone, and she's been able to pay her house off, not in 30 years, but in 6 years. And there's nothing better than getting letters from borrowers that you've helped, knowing that, hey, yes, it was a win-win. Yeah, hey, you made some money. I don't run a charity, but I want to help people. You know, I love that. I love the stories I get from borrowers of us helping them stay in their house and finding a way to make it a win-win. And that's one of the beautiful things out there. We have the opportunity, if you're buying debt, to make it a win-win. The banks, if they're on the origination side, they're onto it. Now they've got some tricks, but they often have to be motivated for things to hit that 6+ month to foreclosure or 6-month default rate. That's what I'm trying to get at, everybody. The banks right now, if you look back at March, April, May, June, they're really only about 4 months. The default, that 6 month, July, August is when we are going to see, okay, yeah, I need to, these non-government backed stuff, Fannie and Freddie's not going to bail me out. I need to focus on getting this stuff off my books. And you can do it on either a big basis or do it on a small basis. All right. My buddy Gene here out of Elkhart, Indiana, started off very, very small. He was a long haul hot shot driver across states, buying stuff in just his backyard. Now, Gene's bought over 134 assets, 13 million in the market, and making seven figures. He emailed me the other day and said, "Thank you, Scott, for what you've taught me." Our rock star Laura Blanc here, she's done an amazing job. Just moved out to Maryland from South Texas here, Central Texas, I should say, not South Texas. Started off buying a couple assets. She was like many real estate investors, trying to figure out how to make money as a real estate investor. Do I need a wholesale? Do I need to light flips? You know, running around like a chicken, your head cut off, going to all these workshops doesn't help. Oh, add this to your tool belt. No, we don't need to add tools. In our business, the pen is mightier than the hammer, everybody, in the debt game. And I'm so proud of what she's done. Bought over 100 assets in the last 3 years, and then working on a trade right now of 100 plus assets, a $4 million purchase price that she's getting at a ridiculous like 53% of unpaid balance on a portfolio of notes that there's already equity above and beyond. Just absolutely amazing. And most of them have been performing for a couple of years in the bank on this. So the person that holds this portfolio is selling a discount because he needs to cash out. Okay. Our friend, Keith Collins from out in Mason, Ohio, done an amazing job, done a variety of things in government and putting water treatment plants together, and investor. He sent me a text message or email the other day too, talking about the fact that he and his wife are going to be making seven figures this year because of what they've learned from me. Seven figures by being in the debt space, buying some non-performing first, buying some contract for deeds at discounts, and really making it work in a variety of ways. Not only just cash flow, but also taking the property back if they need to and selling it. But I get most excited about people that really we make a big impact. All of these three investors are great. We're doing great, fine, but we've really took them to a whole nother level. It's when you can help somebody out who's facing a rough time. And I know a lot of us know people out there that need to find a solution. And that's why I'm so proud of Raphael here. Raphael's out of San Diego, a student of ours, owns a did own a detailing shop, a mobile detailing shop in San Diego, but with nobody driving, nobody's wanting to wash their cars. They sure as heck don't want to pay for somebody to come out and wash it when they're stuck at home. So Raphael had to lay basically all 15 of his employee staff off, is closing his business down. If he didn't have the note business, which he started in November, December of last year, he's bought 5 assets in his first 60 days. He got 2 of the 5 assets performing. The other 3 are in such great discounted positions. He's selling 2 out of the 3 off, making a nice chunk of change. Also raising capital from what we taught him, over $100,000 in private capital raised just in the last month from us guidance room. And that's the beautiful thing, guys and gals. I love working with investors. I love helping them take their business to the next level. Rafi, he's like, oh my God, I'm so excited about this now. He had zero real estate experience beforehand. All right. And we've helped him make money as a note investor. And he's going to make more money this year than he has in the last couple because of the things he's doing and the things that we teach, because of the opportunities out there. And I would love to help all of you do the same thing as well too. Like we have helped so many other people across the country buying debt, buying deals. And as I like to say, really turning bad borrowers into good homeowners. All right. And how do you do that? Hey, we've got a one-day workshop we teach called Note Weekend. That's how you tap into it. That's how you get your feet wet. Most of you are like, I don't know. That's why we created this Note Weekend. We usually have like a 3-day, 4-day workshop, but we created back in January. We heard the need from people like, I really want to get my feet wet. I don't know if a full 3-day workshop is something I have time for. That's great. A one-day workshop is what we have called Note Weekend. You can go to noteweekend.com. That is the website. We have the whole schedule on there. We do a great thing on this. It's a mini workshop from 9 a.m. to roughly 5 o'clock in the afternoon, Central Standard Time. As long as people are asking questions, I'm hanging around. And no, it is not a pitch fest. It is just me teaching the Cliff Notes version on a Saturday with you. I wake up and I teach this usually once a month. And it's usually like the 3rd weekend of the month. You can see the times at noteweekend.com or the schedule for it. But usually it's a $99 class. We drop it down to $49, 9 a.m. to 3 p.m. That'll vary. Depend on how many people have on there, how many questions. We open the last hour up for networking so that you can see who else is on there. You can find out what their focus is. You can ask questions live. You can, it's a beautiful thing is you get the replays included. So if you can't make it all sessions, it's really usually around 14 or 15 sessions in the day. We record them. So you can go back and watch them. Oh, Scott, I remember that one. Great. Oh, I need some more help with this one. Okay, go back and watch it. But the replays are included, and we've got a whole variety of different things. Now, what do we cover? Well, the first part of the day is all about finding assets, how and where to find notes, whether it's direct from the banks or lending institutions or platforms. We also, the second part of the morning, second part of the day is also about how to find these deals with other people's money. Okay, OPM, how do you tap into it? How do you build credibility? How do you get people to say yes to funding your deals? Then we dive into the exit strategy side, making some money. What do you do? How do we structure these deals? How do we make money in the note business? And we spend a big chunk of that. We also, like I said, we'll talk about different vendors and team members you'll need. No, you don't need to hire somebody 70 grand a year. There are servicers out there that get paid to do this. They're third party. There's real estate attorneys. You don't have to be the expert. You don't have to be the person talking to the borrower. All you need to be doing most of the time is finding the deals and raising the capital. That's why we start off with those two big things. The workouts, yes, you need to know that, but there are vendors out there and other third party people that will be doing that for you, that you can figure those costs in with the funding side. We'll also talk about a few loan trading platforms that you start looking at deals now, deals today, reviewing them, starting to get your feet wet. And then we'll talk about other things along the way. As you have questions, we'll answer that stuff. But literally, everybody, it is the Cliff Notes. Is what my students call it, the Cliff Notes. Many people are like, oh, this is a great refresher aspect of it, that we got an 18 or 20-page manual to go along with this as well. That's included. Like I said, if you can't make it all day on Saturday, don't worry about it. We get the replays out so you can watch on Sunday. And yes, you can download those replays. Somebody asked me that the other night. Download them and onto your laptop, your cell phone, whatever you want to, so you can watch those at your convenience. Now, one of the things is so many people ask, okay, Scott, is that's all included? Well, we've got some great things on there. We have over $1,000 in bonuses that we throw in with Note Weekend. All right. Obviously, the one-day note weekend training is usually $99. We drop that down to $49. Now, we also throw in a one-day calling banks training where we get on the phone for 4 hours or more, and you hear me actually talking to bankers. That's included. That's usually $49 by itself for 4 hours. But you want to hear me call 50 plus banks in 4 hours, you will learn a lot. You'll hear me talk about the deals, the conversations. And you know what, everybody? It's not nearly as complicated as most people make it out to be. It's great conversation. Last time we did that, we had 4 sources of people that have sent me deals that we've talked to. And I show you how to follow up with those contacts and what to do, how we get transferred, what to say, what not to say to get the right party on the phone. Bauer Financial List. That's usually a $360 cost is what it costs me. I'll throw that in as part of the training. I'll throw that in so you get that included so you can start looking at the list of banks. You can start seeing the banks in the state that you like or the other states that you invest in that have defaulted assets as well. And you can see then that when you're calling banks, oh, we don't have any. Well, I look right here. Yes, you do, Mr. Banker. You've got $3 million. You've got $250 million distressed residential stuff. Let's talk. All right. After the class, we always like to say, hey, let's have a one-on-one 30-minute phone call with me. I charge $1,000 an hour, so that's a $500 value. If somebody wants to pick my brain for an hour, 30 minutes, hey, great. That's a $500 value thrown in. Replays are included if you want your spouse or existing business partner to attend. Not a big deal. We throw that in there as well. It's included. And like I said, we also have a nice private Facebook group for people to join in a network, and that's included as well. So all those added up are well over $1,000, and we are just offering this up for you guys, not $500, not $99, but all this for just $49. You can do this you can get signed up at noteweekend.com. You can see, if you can't make it to the July class, you can attend the August class. Can't make it to the August class, you can make it to the September class. All right. Whenever you're listening to this or watching this, we have a class available. And hey, if you sign up and something happens, I'm not going to sit here and say, hey, well, no, you can't make it. No, look, I had something pop up. I can see if you attend, because we do it all via Zoom, so you don't have to go anywhere. You don't have to travel anywhere. You can do this all from the comfort of your own home, or office, or backyard, or bed. We've had people join us from everywhere, okay? So why should you do this? Let's talk about why you should do this. As I talked about before, I have a passion. If you want to help yourself, borrowers, and help yourself as an investor, this is a tool. This is a tactic that you all need to know about the note business. Some people are like, hey, I like the note business. Scott, I've been through the one day. That's enough for me. It's not my main focus, but I know enough now that I'm dangerous, or it's a good starting point to help you get rocking and rolling. How many borrowers do you need to help to get you where you're at? I often find from talking with investors, if they need to get $5,000 a month in cash flow on a regular basis coming, they need to do somewhere between 10 and 20 deals. Imagine sitting here a year from now and you've helped 10 borrowers out there, help them stay in their house, help those communities do well. And you've been able to do some great stuff as well too. I like to help. Why should you do this as well? I like to help people make money, helping people solve issues, solve problems. Why not? Make some money helping somebody. Okay? You're not taking advantage of anybody. You're helping somebody stay in their house legally. And you're a bank when you buy the debt. So you've got the same rights the bank does. And I'm a big believer this is the opportunity to build wealth. We all know the REO market's oversaturated. Flip this house, flop this house. All those shows are fictional TV. And people are overpaying for REOs, overpaying for rental properties. Why not get something at a discount? You get it the closer you are to the bank, closer upstream you are to the source. And so this is the opportunity to build wealth, long-term wealth, not get rich quick, long-term wealth. And we have a variety of ways we make money. Money on the front end, we get them to modify it. We bring some skin in the game, cash flow, and then either hold it for an asset, either hold it for cash flow, or sell the note off and make a huge chunk. Or if the borrower doesn't work with you and you have to go the legal route, then you foreclose. But the thing is, the longer the foreclosure time frame is in your market that you're buying the asset in, the bigger the discount you get because you've got to take that on. And here's another reason why you should do this. We all know distressed borrowers. We all know distressed borrowers. Would you like to help that? Now, I'm not saying you can't go to Wells Fargo and buy Vanessa's non-performing first lien at Wells Fargo. That's not going to happen. Rarely can you go that back route. But there are a lot of banks out there that have stuff there that they'll send you a list on a monthly, quarterly basis. You might as well help somebody, buddy. Might as well help make America great again, one defaulted borrower at a time. All right? There is nothing greater than helping someone overcome an obstacle or achieve a goal or dream that they thought was impossible. There are a lot of people out there that are struggling. There's a lot of people that are hurting. There's a lot of investors out there like, oh, crap. What am I going to do now? Oh, crap. I'm saying a little bit stronger, I would say. There's nothing greater than helping somebody out. You can help somebody out, make money doing this, and you can learn how to do it. Now, it's a one-day class, the end all be all. No, we've got some other stuff, but you know, one of the things I'll do as well is I take that $49. If you want to sign up for one of our 3-day workshops or one of our coaching programs and stuff like that, we apply that $49 to it. Great. At the end of the first couple hours, like, hey, Scott, I don't think this is for me. You know what? No problem. We'll refund you back your $49 as well, too. We're a big fan of doing the right thing, helping people solve problems. Yes, hey, Vanessa, good to see you out there. So once again, go to noteweekend.com. That's where you get signed up for our one-day class that we host every month. Like I said, one-day online note training basics, mini workshop. You get the replays on Sunday after the event. We go through on Saturday, so you can rewatch or watch if you missed something on Saturday. We call it the Cliff Notes of Investing. I will tell you this. I have been told, this is not me saying, I've been told by many people, this is the biggest bang for the buck. Nobody teaches like I do because I tell you exactly where to go. Other people out there, oh, you can't do it. The bank ain't going to sell you a note. That's a bunch of BS. Banks will sell you one-off notes. I've been doing it for over a decade. I've helped thousands of investors do the same thing as well. Like I say, it's just $49. You can get signed up at noteweekend.com, and would love to have you. Any questions, comments, concerns from anybody out there? I want to thank you, those that have been live with me here and been asking questions. Great stuff. Been commenting. Good to see you all. I encourage you all to take opportunity of this, everybody. Once again, if you go to noteweekend.com, I would love to have you be a part of our class. And welcome to Note Nation and help us all solve things together. One of the things too, guys, if you're looking for deal flow, our students are the first people that see the deals that we get in. And those that are going through Note Weekend, we're like, okay, what are your top 3-4 states? Where are you looking to buy? Okay, as stuff comes in that I get from either myself or other people sending me lists, they're the first ones that we'll send out to. And if you're looking for deals, this is where to do it. Because I'm not going to send a deal to somebody who's never bought a note before. That's a nightmare because most people evaluate things incorrectly, and I don't want to waste my time. Rather teach somebody how to do it. Go to noteweekend.com, go through the training, learn how to do it, learn how to evaluate, understand what you're looking at, and be a smarter investor because you actually have a why. Yes, if you have a why in what you're doing, it makes things a whole lot more fruitful for you, as I say, because you have something that you're working towards. And I'd love to help anybody out there that's looking to help expand their why and cash in on what's going on in the market right now in a good way. So I want to thank you all. Have a great rest of your evening, great rest of your week. And we'll see you guys all at the top, everybody, unless there's any other final questions. I'm a baseball fan, so I'm wearing a Philadelphia hat, Phillies hat. I would not wear an Eagles hat. Sorry, I'm a Cowboys fan. Can't come to wearing a Philadelphia Eagles hat. No offense, everybody. Philadelphia is a great city. Spent quite a bit of time up there. It's a great market. I think there's a lot of opportunity, especially here in the next 6 to 12 months for everybody out there. So if you're looking to tap in, guys, not just in Philadelphia, otherwise, we have a whole variety of other cities that we're hitting. If you go to notenationtop40.com, it's notenationtop40.com. You can check out the other schedule, cities that we're scheduled to hit over the next couple of weeks. And you also catch the replays, as we'll post the replays on the website as well there for you. So otherwise, be safe, stay out of trouble, and we'll see you all at the top, everybody.